Next speaker, Mr. Pradeep Kumar Kesavan, who is an equity strategist at SBI Funds Management. He has over 18 years of experience in fund management and strategy. He would be making his presentation on investing strategies for the next decade.
Good afternoon, everybody, and thank you so much. First of all, Mr. Harish, for the kind words, and thanks for the opportunity. So when I was first given this topic of investing strategies for a new decade, I was reflecting on what is it that I should share with you all for the next half an hour. I can talk about many things here. I can talk about, for example, the base fundamental idea of investing, which hasn't changed, not just in previous decades, it's not going to change in the next decade also, which is buying low and selling high. I can talk about that. I could have spoken also about the fact that the investment landscape has changed quite a bit. In the last 1 year itself, all of us know the amount of new age companies that have hit the market, the kind of different products and different kind of disruptive companies that have hit the market, and therefore, how a typical public investor is now today increasingly being asked to put on the hat of a private investor and think like a private equity investor increasingly, because a lot of these companies that we are encountering are A, disruptive, B, loss-making, and we are therefore having to project ourselves far into the future and visualize as to what is it that these companies are going to make in terms of an impact for the investors. That would have been an interesting topic as well. Or, being an equity strategist, I could have looked at the macro picture. I could have spoken about, okay, last 10 years we have enjoyed a very nice macroeconomic environment where the interest rates were low. We were having a low rate environment, low discount rates, higher valuations, globalized economies. Prosperity is growing everywhere, therefore markets were doing very well. Standing today, things are getting challenged on each and every one of those counts. For example, are we staring at a situation where we are going to face a longer inflation for the next decade to come? And therefore, what does it mean for interest rates? Therefore, what does it mean for discount rates? And what does it mean for investing? That could have been an equally interesting topic as well. Let's take one macroeconomic thing that happened in the recent year and think about what happened there, right? The Russia-Ukraine war, when it started, nobody knew it's going to start. It did start. When it did start, everybody thought it's going to end soon. It did not end, it's still continuing. Now that it's continuing still so far, nobody knows when it's going to end. And that is a typical situation a professional investor faces in his or her career. And it's not unique. And none of the other things that I spoke about investing is also that permanent. It's all transient. And as investment professionals, we are paid to take a call to navigate this landscape, which is ever-changing. And therefore, I wanted to focus my attention and therefore draw your attention to what is that which is permanent in investing. And to my mind, what is permanent in investing and which is not going to change not going to change the next decade is having a robust investment process. When I say robust investment process, it's not like I decide on a way to look at a particular stock, for example, and then that remains static forever. Things change, things evolve, but the essence of what goes into investment decision making and how can you strengthen that process is going to withstand this test of times, and that's going to stay with us for the next 1 decade. So with that as a background, let me just quickly move on to what I thought I will share with you. And towards the end of it, I will also just take a minute to show as to why is it that these are important for us as advisors. When I started my career back in early 2000s, right, sometime in 2003, 2005, I've had opportunities to interact with massive asset managers, very big asset managers, interact with portfolio managers who I was in awe of, right? And I used to meet them, ask them these questions as to how is it that you invest? What is your investment philosophy? How do you go about deploying your portfolio? And typical answer that I used to get back then is we meet managements, we talk to companies, we like the stories, right? So that's what I call as story-based investing back then. And on the analytical side, I used to probe a little more as to what is it that you do. And I used to be shown a small A4 sheet paper on which a list of names are written, few very, very broad numbers written, right? That typically would involve some sort of a multiple, and then that's pinned onto his board, and he says, okay, these are the numbers that brokers have given, we keep tab of some of those, and we are done. From there, right, 2008 was a big shock. Right? That kind of focus forced a lot of investors to also kind of double down on the investment processes. But still, a lot of us continue to be what we call as a bottom-up stock picking, stock selection oriented investors. From there, where we stand today, for example, we have kind of evolved into this process into a much more robust sector, where in addition to basic fundamental investing, we've also started looking at, let's say, macro indicators. A role, for example, the one that I play as a macro strategist was probably not really existing in purely a mutual fund setting. If I go back 10, 15 years, most of the fund managers were stock pickers. Today, macro finds its place. Incrementally, we are seeing that quantitative elements are coming into the investment processes. We'll also look at why that is important and how that can add value to the investment process. And something that's very close to my heart, ESG, how that finds a place in investing. And the other small thing that you might notice in my deck here is I have not put arrow marks to represent that, okay, macro means top down, you need to look there up and then come all the way down, and fundamental investing looks bottom up, and then therefore you need to first look at the stock, so on and so forth. It's a smooth circle. The point being, when you look at investment decisions, you need to take your cues from each and every aspects of this. A robust process which can withstand its test of time should draw insights from each and every element of this. Right. The first element, as I shared, is the fundamental aspect of it. Now, fundamental investing is about finding good businesses run by good management, buying it at a good price, and you're done. That's the holy grail of investing, right? That's what most of the stock selection theories are about. That's what most portfolio managers focus on. But how do we go about doing that? What is it that will help a fund manager, an investment manager, an investment analyst to do it day in and day out and reduce the probability of errors and increase the probability of success? There, we need to have several other things in addition just to, story-based investing, as I started off with. One of the things that a good investment process should have, ideally, is an investment checklist, right? Now, a checklist is a very simple way, but nevertheless a very, very effective way of managing investment process. Easy corollary that you can draw is in the airline industry. When an airline commander takes charge of his or her flight, it doesn't matter the level of experience the commander has. He or she can be 20, 25 years into flying, but every single flight that he or she flies, there is a checklist that he or she is expected to follow to the T. You are supposed to do this at this particular time. Why is it needed? It is needed because as human beings, we are prone to our biases. We are prone to making errors, especially at stressful situations. And having a robust checklist kind of puts a check and a balance and helps us take the right decision which is expected to be taken at that point in time. Now, in the context of investment industry, what does a checklist do? Right? We spoke about the BMV process, right? What business, what management, what valuation. But a checklist will actually help us do exactly what is it in the management that I should be looking at? What is it in a business that I should be looking at? What are the industry dynamics that I should be looking at to get a view for me to make an opinion on a particular company and figure out whether it is worthwhile for me to put my money into that, right? That is extremely, extremely important. A very, very simple example, right? We do a huge amount of channel checks just to understand how a particular company is doing. We talk to suppliers, we talk to customers, we talk to competitors, and a typical way an investor, an investment analyst does go about his or her job is if a person is tracking, let us say, an automobile company, he or she will talk to automobile companies, they will do a plant visit, etc. Now, when a person does a plant visit for an automobile company, how do you make that person also look a little more holistically and make the investment process a little more enriching? Can he, for example, look at the air conditioning of the plant. What is it that's going there? By doing that, can we help our industrials analyst who is sitting right next to him, but did not have the opportunity to be with him in this particular case, right? That's a very, very simple example, and you might wonder why I'm even bringing up such a trivial thing, but it all adds to the process, right? What it ends up at the end of this checklist process is it gives the confidence to the analyst. Every investment decision. So typically, if you ask an analyst, what is your hierarchy or what is your ranking? What are your top picks? People have a list of companies to share. Okay, I like company A, company B, company C, in that order, so on and so forth. Now, when you go back and ask them, what is your confidence with which that you can give this order? Typically, you'll notice that there is not a very good answer to that. If you need a very good answer and a very good confidence score in saying, okay, I can say with confidence that company A is above company B because of X, Y, and Z reasons, you need to have this, right? That's point number one. Second thing that goes into a good fundamental investing is the valuation frameworks aspect of it. Now, one of the things that have evolved to a certain extent over the last 3-5 years is to slip away, go away from a typical multiple-based valuation method. Okay, so what is the company, what is the target price? I look at this company this way, therefore the PE multiple is this. I expect the PE multiple to go to Y. From X to Y, this is the delta, and therefore this is my target price, and therefore you should buy the stock, and there ends the issue. Now, what we like to do is force our analysts to think long-term. One of the ways to make them think long-term is to look at a company through the lens of an intrinsic valuation framework, which will make you look at not just the multiples, but also from a cash flow perspective, from a residual income perspective. What is it that the company capable of generating in the next 3 years, 5 years, 7 years, 10 years? Force the analyst to think through in terms of investment cycles, industry cycles, and not just the next couple of years, right? That is extremely vital, especially in relation to the topic that has been given to me in terms of how do we invest for the next decade. If you want to invest for the next decade, you cannot be looking just at the next year, and 1 year PE multiples should not have a great place in that investment scenario. I'm not saying it should not have any place at all, but there are ways to move beyond that and start looking at things which are more robust than that. The second element is having done that, right? So most of the analysts also have this habit of giving a point-in-time estimate. My target price for company A 1 year out is 205 rupees 50 paise. The only thing that is absolutely sure about this particular thing is it never comes true. Nobody with any amount of conviction can say that a company's share price will be exactly this 1 year, 2 year, 3 year, leave alone that, even 1 week down the line, right? Yet, it is a standard industry practice that you will see that there is a target price. Now, how do you kind of make analysts think not about a point estimate, but about a range of outcomes, right? In the real world, we are working in a range of outcomes scenarios. Companies face various difficulties. We have certain assumptions. Certain assumptions come true, certain assumptions don't come true. So what if things go as per my expectations? What are the things that are possible? What if things don't go as per my expectations? What is it that I'm going to do there? When you force fit this kind of a templatized thinking and then think about a bull, bear, base case and assign probabilities to each of those outcomes, then you'll realize that what I have is not necessarily a target price, but a range of values. Okay, I know this company is here, and from here it can go in multiple different paths, and most of the paths with certain amount of conviction I can say is stretching towards the positive territory, and therefore I'm positive, right? So that is the way we would want analysts to incrementally think about, and that's going to kind of add to robustness to the investment process. The last bit about the framework part is how do you triangulate the whole thing, right? So just to touch upon the point that we as analysts always tend to carry our biases with us. We can be overboard with certain assumptions that we made. So it always is a good practice to have a check and balance. And one good way of having a check and balance is to have an outside and valuation framework. By outside and valuation framework, what do I mean, for example, is we are operating in a public market environment where the price of a security is publicly available. And the price is something that has been derived by millions and millions of investors. Therefore, it has an immense power to that particular number, right? So can I, for example, start with that price that is already available and then back work and reverse engineer my calculation and come to certain assumptions that would have gone into that, making that price, and compare and juxtapose that with what I have with my model and question myself as to whether am I doing it the right way. Am I too optimistic versus the market? Am I too pessimistic with the market? Market is somewhere and I'm somewhere. Is there an adjustment that I should be making? So this is something that's going to help us in doing that. So the three different aspects, the multiples, the intrinsic value, and the outside-in methodology, all have its place, but the right way to do that will be to have everything, not choose between one or the other, but have everything and have a triangulation happening. The final thought that I'll share with you on the fundamental aspect is the forensic accounting element, wherein we have data-based evidence to show that companies with top-notch accounting standards and accounting quality tend to outperform in the long term. There is data to back that, and there are methodologies to figure out as to what those accounting qualities are, and what those frameworks and methodologies also show us. It shows us the red flags that we should be talking about. Right? So in our industry, as you all know, that we are allowed to have up to 10% of a company's capital. When you are owning that much of a company's capital, you definitely need to know what has gone into the numbers that you're reading day in and day out. Right? Most often what you'll notice is the analysts are spending huge amount of time analyzing the annual report, etc., but without paying real attention to what has gone into this annual report. Is that annual report copy worth the paper on which it is printed? I can give you examples of very big names where companies' auditors, who are signing the books of accounts of the company, have not audited 50, 70, some cases in 80% of the assets of those companies. Those have been audited by somebody else. Those opinions are not part of it. This particular auditor has audited 20% of the company's asset, and his or her opinion is on the front page, and that is what we take it as a vouched accounting standard. We need to really go behind all these numbers to figure out the red flags of that. If we do that, especially this becomes extremely important for new companies that are coming for IPOs, companies that you're covering new, in terms of new initiation, etc. That will give you a good glimpse as to where all are the issues that you need to be really questioning the management about, and what is it that we should be looking for in a company, and what can go wrong if we don't pay attention to certain areas. Right? So that kind of summarizes what I thought I should share with you on a fundamental perspective. Slightly shifting focus onto the macro side. Again, you'll notice here that macro, as we all know from a top-down perspective, macro indicators, one way of thinking about equity returns is a function of valuations, it's a function of earnings, and it's a function of sentiment. Right? Mix and match of these three components will result in the returns that we see at the end of the day. And each and every element of those top boxes there will be impacted by macros. Right? So when we talk about macro, one thing that gets very easily missed out is incrementally we have seen some movement in terms of macro analysis, etc., being done in the industry, but what usually happens is there is a bit of missing pieces in a macro analysis in terms of connecting the dots all the way down to the equity return part. The reason why I have kept the two boxes next to each other and also kept the equity returns right where I will also talk about the macro is, if we do not find a way of percolating the macro analysis all the way down to equity returns, then to a certain extent that particular analysis ends up being not so very useful. Also, where is it that we would want to deploy that? Like, it's one thing to say that, okay, good companies selected on the basis of good management, good businesses, got at a good price will always outperform, irrespective of any conditions. But it is also equally true that the regimes do change, market regimes do change from time to time. And is there a way in which we can keep track of some of that? For example, prior to 2008, most of us here will know that the type of companies that performed very well from 2000 to 2008 were completely different from the type of companies that did well from 2008, maybe till up until COVID, and maybe post-COVID, who knows? I mean, can we come up to a conclusion using some of these parameters as to what is it that the new regime is going to be, right? So something of that sort, if you need to really do and then place your bets on a shifting regime or shifting market preference, then this part of the analysis becomes extremely important. Say that I am a value-based investor, I am a value portfolio manager, I value portfolios from a value investing standpoint. Can we juxtapose these positions to what market looks at as value and then say as to whether you're actually true to your style, right? If you would be surprised that if you do this analysis across the street, it is not always that all fund managers actually stick to what their preferred styles are. Styles do change from time to time, and analysts also, fund managers also deviate from their style. The other angle of that is, if the market, like it has done, for example, in the last year, value has outperformed the other parameters. Now, if you're a value investor and you've made a lot of returns for your investors in the last 1 year, is it you that is generating the return in the last year, or is it because the market has shifted towards value and you have tended to be a value investor and therefore you just benefited from the trend? Now, we can systematically throw these data points at the fund managers and challenge them as to what best can you bring for your investors there. It also kind of helps us in terms of, having backtested quantitative models that comes up with its own portfolios. That can again be used to measure performance versus performance of your real life portfolio, see if we can draw some lessons out of that. And it also helps us in sizing and optimization in many ways, in terms of one of the biggest challenges as a portfolio manager will be sizing, right? So you know that the analyst has said that it's a great company, wonderful product, everybody has great reviews, we need to put in money. Now the question is, how much money should we put? Should I put 2% of my portfolio? Should I dedicate 7% of my portfolio? What is it that I'm going to do, right? So that's a very tricky question to answer. Quantitative strategies, to a large extent, can help, not fully provide the answer, but help you in the right direction getting that. So that's an important part of the investment process that I thought I should share with you. Last bit about ESG, as I said, extremely close to my heart in terms of where we started, where we are. Like if I had been talking about investment processes in front of you maybe 5 years back, this particular slide may not have found a place in this deck, right? How many of us really knew what ESG was back then? But today, there is incrementally huge amount of press that has come in for sure, but it's also equally true that it is finding increasingly more and more important place in the investment decision process of every serious investor that is out there. The way things have evolved in ESG investing, it first started with elimination. By elimination, what we did was essentially, okay, I stand for certain values, and therefore, I will not look at particular type of companies. Those type of companies could be anything. It could be alcohol, it could be tobacco, it could be defense manufacturing companies, so on and so forth. So I'm not going to buy those companies, everything else is fine, I'm just going to buy that. From there, in terms of elimination and screening, then we started moving to an era of assessments. By assessments, what we did was essentially, we will assess every company based on E, S, and G. We'll come up with a composite score, and any company which is above a composite score is a good company, any company which is below that is a bad company. Now the problem in that assessment is the assessment itself was not made in-house in most of the cases, right? It was done mostly by third-party agencies like MSCI, Sustainalytics. So typical answer to a question of, okay, what is your ESG score? Is it good, bad for this particular company? Yeah, this is a good ESG company. Why do you say so? Because MSCI said so, right? I don't know. That is the situation where we were. Now, incrementally, what is happening is we are moving into the era of engagement. By engagement, what we do is engage much more deeply with the portfolio companies, engage with the companies directly on matters that actually contribute to their ESG successes, understand if there is a ESG strategy behind how the company operates, and come up with our own in-house score of what ESG stands for. Now, engagement has actually helped us in two different ways, right? It eliminates companies. So there are two types of companies. There are companies which do less but talk a lot, right? That's what the very famously used word of greenwashing, wherein companies project themselves as extremely green, but in reality they may or may not be so, right? So only by active engagement you will be able to decipher the real issues that the companies may be facing. We have also seen at the other end of the spectrum where there are companies which are actually doing quite a bit on the ground, but they've been shy in talking about their ESG measures, and because of which their scores have been affected, and therefore a lot of global investors have not been looking at them. There have been examples where we have been able to engage with such companies, tell them, okay, if you're doing so much, you need to talk to this ESG rating provider. You need to provide this information. Based on this, your ESG scores can increase. Now, currently, that's the direction in which this is moving. This is, in my mind, here to stay, the ESG part of investing, and incrementally you will only hear more and more about it in terms of how investors are assessing companies on these parameters and how these parameters are extremely, extremely important to find place in anybody's portfolio, right? Having covered all that, the last parting thought I thought I should leave you with is, where does all this fit in terms of investment process, and what is the role of technology, right? Now, technology in investment is extremely important. We haven't had the kind of technological breakthroughs that have happened in the last 3 to 5 years are humongous, right? Today, for example, there are NLP programs which can read a 200-page annual report and give me a 2-page summary in a fraction of a second. The level of intensity with which an analyst had to read through scores and scores of papers and make human errors are increasingly getting eliminated now. Now we are having portals and investment portals and investment research equipments where you just have to type anything that you want and it is there at the fingertips and a fraction of a second. And I'm not talking about a Google type of a search here. We can have customized searches. We can have, for example, there were times where analysts used to spend hours and hours listening to earnings transcripts and calls, understanding what the managements are talking about, so on and so forth. Today, technology can help you analyze the past 20 quarters, past 40 quarters. It doesn't matter how many quarters data do you want to analyze. You put that in there, ask for the sentiment, and it will give you all the things. It can give you things as minute as a deflection score. What is a deflection score? An analyst is asking a question to the management is not answering to the face of the question, instead they're talking about something else, then there is an issue. There is a deflection score, and technology can capture it. So technology is here. Technology is going to revolutionize this industry. It is going to be with us. So that is going to be extremely important part of the investing process. As of now, the all-encompassing box that you're seeing here is, it can touch upon every aspect that we have covered so far, right? So technology is going to be a game changer when we think about investing into the next decade. With that, I will pause and I will probably share my last bit as to why this topic and why, as mutual fund advisors, should we be thinking about these things. So we as advisors, people here in this group, when you look at asset manager, when you look at their offerings, when you advise your clients, and when you do your diligence on asset managers, I thought these things could be of good help to you. And with that, I will thank you again for your opportunity and take leave. Thank you so much.
Thank you, Mr. Kesavan. Please be on stage. May I call on stage Mr. Raghuram from Shivamogga? Chapter Head Shivamogga, Mr. Raghuram, and Vanita, Joint Secretary, as well as Mr. Kannan, leading MFD from Bengaluru. Yes.
Hello. Thank you so much. Thank you so much. Hello, sir. Good to meet you.
Kannan.